Why not put your money to work? 3 out of 4 of all shareholders are in families which make less than $10,000 a year. Companies listed on the New York Stock Exchange. Of listed securities, all bought and sold on the New York Stock Exchange.
Hey, what's up guys? Welcome to the channel. Andre here. Whenever you turn on the news today, it seems like pretty much everything is terrible. Whether it's the pandemic or the second, third order implications of the pandemic, you're pretty much guaranteed to turn on the TV and see something upsetting. One of those topics is, of course, the economy, and more specifically, the stock market. Back in March, the Dow took a hit of about 10,000 points, but ever since then it has slowly but surely been recovering. While investors might still be bearish on the overall outlook, certainly it seems like the trajectory is going to be positive until the next disaster strikes. But the problem, the real problem, is that I think a lot of people don't understand the sentences that I just said. So, in this video, we're going to take a very not deep dive into the economy, and more specifically, how the stock market works, what it is, where it came from, and how it actually impacts your life. Roll the credits. So in this video, we're going to take a look at the stock market. But first,
and now, a disclaimer. Don't make investment or other financial decisions based on what a guy in a YouTube video says. This has been a disclaimer.
Let's start with the ultra basics.
You can own a share of American business.
A stock market is just a group of individuals who are looking to buy and or sell shares in a company. A share represents ownership, also known as equity, and usually aligns to 1 vote per share in any kind of major managerial decisions. So really, when you're trading stocks back and forth, or trading shares of stock back and forth, what you're doing is buying and or selling the ability or the privilege of having a say in the managerial decisions of a company.
And get some practical advice.
So if you imagine that a company issues 5 shares of stock, that means that up to 5 people can own stock and therefore have a say in the way the company is run, if you assume that each person owns exactly 1 share. Generally speaking, people will own more than 1 share of a company, and therefore, whoever has the majority, or in some cases a plurality of the stock, meaning they have more shares than any other shareholder, can make the majority of the decisions on their own without necessarily having to get approval from other shareholders.
What are you gonna sell me?
This kind of distributed ownership in companies started back in the 1600s with large shipping companies that were sending boats along trade routes. See, the problem was they kept sinking or running aground or getting taken over by pirates. And so that created a tremendous amount of risk. If you owned a boat that sank or was taken over by Jack Sparrow, you lost not only the ship and potentially the lives of all your crew, but also everything that was on that ship. That was a huge financial loss. So what they did was that a bunch of owners of shipping companies got together and said, rather than each owning 100% of any 1 or 2 or 3 boats, how about they share ownership in a bunch of different boats in each other's boats, so that if any one of them sank, it wouldn't mean complete bankruptcy and collapse for any one of the owners, because they each held shares in each other's boats. Now, this is an oversimplification of the actual contractual mechanisms that were taking place, but you get the idea. The point was to spread risk out across a variety of different assets so that no one person would suffer if calamity struck. Over time, this shared or distributed ownership model started being used in a variety of different types of businesses. Public ownership in companies has been called the single greatest innovation in human history. And I think there's 2 reasons for that. The first is that by pooling resources from large populations of people, you're able to take previously inconceivable projects, things of such size and scope that you could never actually imagine pulling them off, and suddenly you can do it because you have access to the capital from a large amount of people, and you're able to incentivize them to contribute by providing them with a share of the profit. By opening up these types of opportunities to normal people, rather than consolidating them in the hands of an oligarchy or an aristocracy, you're creating an engine of upward financial mobility, the likes of which we had never seen before. On the other hand, it's not all sunshine and rainbows. If you think back to our example from the 1600s, if you owned one ship, you were highly invested in making sure that it did not sink, that it was not run aground or attacked by pirates. Maybe you would invest in more crew or more cannons or more guns or escort ships to protect it from pirates or enhanced repairs to make sure that it could sustain damage and not sink. But if you own a small fraction of a bunch of different ships and any one of them sinking is a sort of trivial loss to you, well, how much are you going to care about the safety of that crew if you figure, yeah, something's going to sink eventually? You're a little more likely to say, yeah, screw it. Let's see what happens.
Every day, member brokers buy hundreds of thousands of shares of stock.
We've talked about the buying and selling of these things called shares, this stuff called stock. But where does that actually happen? Where is the stock market? Well, generally speaking, it's right here on your phone. Most people will buy and sell all of their stock either on their phone, tablet, or computer, but there are physical buildings that are generally known as stock exchanges where a lot of transactions also take place. And they have these buildings all over the world, whether it's New York, London, Shanghai, Tokyo. Major cities all over the world have these massive buildings, often glass and metal and steel, which is a metal, or like in New York with big columns and statues, all to present this front of sort of capitalistic opulence in which all of these transactions take place.
How do I get the facts before I invest?
One of the hardest things to penetrate when you're talking about the economy or finance or the stock market is all of the jargon. There are so many terms and slang and just figures of speech for things where you're just like, really? You couldn't have just said that? You had to use this other phrase or term from the 1800s or whatever? So now we're going to go through some basic vocabulary just to kind of clarify what different things actually mean.
But we can give you many facts and figures to help you select a suitable stock.
First, we're going to talk about the Dow. Also known as the Dow Jones Industrial Average, this isn't really a term as much as it is like a thing. It's an institution. The Dow Jones Industrial Average is a weighted average of the stock values of 30 companies from across the economy. Specifically, these 30 companies. Now, the idea is that by looking at a cross-section of firms across the economy, you can consolidate into one number, the Dow Jones Industrial Average, just how well the economy is doing on the whole. The idea being that if it's doing really well, then these companies' values will be higher, and they will be representative of different segments of the economy that affect different portions of the population. Unfortunately, the problem with this is that stock price and economic activity are not always correlated. They're not always connected. For example, if Walmart's stock is doing super well and they have sales through the roof, well, that might just be because people are suffering economically and want to go to a place like Walmart for discounts on products like food or toilet paper or whatever household items they might need. So improved sales, which can indicate increased stock price, don't always actually mean positive things for your economy. The next two terms we're going to talk about are a menagerie of sorts. We have the bull market and the bear market. Now, A bull market is usually referred to as something that is energetic, it's raging, it's going, there's a lot of energy, a lot of transactions are happening, and generally, the idea is that that indicates upward trajectory in prices. A lot of people are buying and selling. In theory, more people are buying than selling, and therefore stock prices are going up. There's a lot of energy and enthusiasm in this market. On the other side of that is the bear market, which is kind of lumbering and slow, doesn't really want to do anything except maybe take a poop in the woods and then go and hibernate. It's probably more graphic than it needed to be. The point is, a bear market is more aligned to slowness and a lack of activity. So when people say, oh, we're totally bearish right now, that means that they are less inclined to engage in a transaction due to some factor or a variety of factors that they observe. Because of the difference in pace between bear and bull markets, a bull market, an active sort of frenetic market, might be more inclined to see short-term trades, whereas a bear market might see longer-term investment positions. Now, this brings us to our next set of terms, which are both technical in nature, but then also have sort of like a slang connotation. And that is a trade versus an investment. Any purchase of a stock is technically, in the textbooks, considered an investment. And it is facilitated through a trade. But colloquially, sort of like the slang, if you are invested in a company, it strongly implies that your interest, your willingness, is to leave your money there for a prolonged period of time, let's say a year, with the interest of watching how the company grows over time. On the opposite side of that, you have a trade, which is intended to be a much shorter purchase-sale transaction. So if I were going to trade in and out of a stock, let's say I buy Apple a few days before the iPhone announcement, and then I sell it a few days after the announcement, my goal is to try to capitalize off of some specific event and do a quick transaction to try to make a small or potentially large amount of money in a short period of time, rather than being in a long-term buy and hold position.
Before I invest, I'm going to study the facts myself.
I could sit here and tell you about vocabulary terms for like the next 6 weeks. Luckily for us, we live in 2020, which, while the world is collapsing around us, we're able to get access to all sorts of information, whether it's podcasts, books, radio shows, websites, because this video is not sufficient to go out and start investing. But hopefully it provided you with some small modicum of information that maybe you didn't have before, and provided you with even a smaller modicum of entertainment. Who's to say? Okay guys, that's it for this video. If you enjoyed it, hit the like button, hit the subscribe button, share it with your friends, family, whoever else you talk to. And as always, you will see me in the next video.